ETFs feel like magic. One click and you own the market. Stocks, bonds, gold, oil, even volatility, packaged and delivered before your coffee cools. Fees so low they feel like a rounding error. Instant diversification, tax efficiency, liquidity at your fingertips. It's the investing answer to the modern craving. Everything, everywhere, all at once. But step back and ask a simple question. If it's this easy for everyone to buy everything, who's doing the selling, who's actually setting the price, and what happens when the tide rips the other way? Convenience is the surface. Underneath are currents you rarely see until you're already in them. This is the place where money, power, and history collide, where clean narratives break on the rocks of market plumbing. Exchange-traded funds didn't just democratize investing, they rewired the pipes. They changed how prices are discovered, who wields voting power inside corporations, how taxes interact with portfolios, and who eats liquidity risk when the weather turns. The promise is soothing. Own everything. Sleep well. The reality is less comforting. You're floating on a river with eddies, undertows, and a few waterfalls. To understand the river, we need to look at how the banks were built. The desire for a risk-spreading wrapper is older than the ticker tape. In the coffee houses of Amsterdam and London, centuries ago, investors pooled money to purchase baskets of assets. The modern mutual fund grew from that impulse. Diversify, simplify, outsource the picking. By the 20th century, the form was standard: professional managers, daily pricing, and a structure that gave small investors a share of big markets. Then a radical notion arrived, dressed as common sense. Most of us should not to try to beat the market, we should own it. Index funds took the ego out of the equation and replaced it with a mirror. There was one catch. Index mutual funds moved at a walking pace. You bought or sold at the end of day price after the market closed when all the reckoning was done. No intraday trading, no quick hedges, patience required. That changed in the early 1990s when the first major exchange-traded fund opened a new door. The same index exposure, but in a chassis you could trade like a stock. Now the price updated every second. A small club of large firms stood ready to keep the fund S price close to the value of what it owned. It was the smartphone upgrade to a flip phone, functionally familiar, experientially different. Once investors tasted that, there was no going back. On the screen, an ETF is a simple creature: ticker, price, buy button. Behind the screen, it's choreography. Authorized participants, big trading houses with balance sheets and speed, are the only ones allowed to mint or melt ETF shares. When demand rises and the ETF trades above the value of its holdings, they deliver a basket of underlying securities to the fund and receive new ETF shares in return. They sell those shares and pocket the spread, pushing the ETF back toward fair value. When the ETF dips below the value of its holdings, they buy shares of the ETF, hand them back to the fund, and receive the underlying securities, shrinking supply and pulling the price back up. That arbitrage loop is the quiet metronome behind the convenience. Market makers quote prices all day, warehousing tiny slices of risk for tiny slices of profit. Many ETFs exchange securities in kind rather than cash, letting the fund push out low basis positions and avoid large taxable distributions. Your experience is a smooth line of numbers. Their work is a ballet of boxes checked at machine speed. The bright side is undeniable. Fees fell like a stone as competition intensified and scale economies were shared with investors. Access exploded. You can buy a country with a few letters, tilt a portfolio towards small, value, quality, or momentum, or express a macro view without learning the mechanics of futures and forwards. Transparency improved, often dramatically. Many ETFs publish holdings daily. You can see what you own with a few clicks. And the tax code's quirks, combined with in-kind redemptions, turned deferral into an art form. Fewer capital gains distributions, more of your compounding left alone. But safety is a story, and stories skip chapters. The first missing chapter: liquidity is a shapeshifter. Intraday tradability is not the same as deep liquidity. The ETF's liquidity lives in two places. There's the liquidity you see on the screen. How many shares traded today? The penny-wide spreads on calm afternoons. And there is the liquidity under the surface, the ease or difficulty of trading the actual securities inside the fund. When those two liquors have different proof, the drink hits harder than expected. Consider a bond ETF. The wrapper trades like water. The bonds themselves often trade like mud, by appointment over the counter with quotes that disappear when the room gets loud. In quiet times, arbitrage glides. APs can source the bonds, deliver them to the fund, and unwind positions with the precision of a watch. In storms, bond prices go missing. Bid-ask, spreads blow out. The ETF S price starts to move faster than the stale marks that feed the stated value of its holdings. Discounts appear. To a casual eye, the ETF looks broken, as if it's failing to reflect the value of what it owns. In truth, it may be the opposite. The ETF becomes the price discovery machine for assets that aren't a T trading. It tells you the truth the bond market won't print. That truth is cold. If you want out now, this is where real buyers are willing to meet you. The same current runs through small caps, frontier markets, and anything thinly traded. The wrapper can move more easily than the contents. In stress, the ETF price leads, not follows. Your liquidity is real, at a price. Picture a bridge over a swamp. Most days the planks hold and the air smells like freedom. In a flood, you discover the ground beneath was never concrete. The second missing chapter. The myth of always fair value. ETFs aim to track. They do not swear a sacred oath. In fast markets, especially at the open, many of the underlying securities may not have fully updated prices. The ETF trades anyway, synthesizing where buyers and sellers believe the basket would clear. Exchange halts. Fragmented venues and missing ticks widen the gap between a calculated net asset value and the only number that ever matters, the executable price. When stress rises, authorized participants can step back. Spreads widen, balance sheets fill, or uncertainty becomes too costly to touch. The arbitrage loop loosens. The ETF trades where humans and algorithms actually agree, not where a spreadsheet says they should. That's not a glitch, that's market structure revealing itself. If you trust a published NAV more than the price on the tape, you're trusting a map over the terrain. A third chapter hides in the label. Not every ETF owns the thing it promises in the way you imagine. Some funds deliver performance through total return swaps with banks. The fund holds collateral. The bank promises the index return. The benefit can be cleaner tracking and better tax outcomes. The risk is a chain of counterparties and collateral terms you probably haven't read. Commodity exposure carries its own quirks. Oil in a ticker often means oil futures, not barrels. The fund must roll expiring contracts into new ones. When the curve is upward sloping, when future oil costs more than spot, each roll sells cheaper and buys dearer. Slowly, quietly, performance leaks even as the headline asset rises. Industrial metals stored in vaults raise questions about custodians, sub-custodians, lending, and what happens when demand for paper metal outruns the warehouse. The label says exposure. The legal documents say how. The difference matters. Then there's leverage and its seduction. Daily reset leveraged and inverse ETFs are engineered for traders. They target multiples of the index's daily move, not its long-term path. In choppy markets, volatility drag gnaws at returns. 2 up, 2 down, and you're not back where you started. The math keeps a tax you didn't see. Some volatility-linked products amplify this effect in ways that can stun. When the underlying spikes or collapses, the fund's rebalancing can force it to buy high, sell low, and chase its own tail. The feedback loop is real. If you wouldn't store fireworks in your living room, don't store daily reset leverage in your long-term account. Another current runs through the structure of indexing itself. ETFs quietly outsourced choice to index committees and weighting formulas. Who decides which companies belong in the market? Inclusion is oxygen, exclusion is suffocation. When a stock is added to a major index, passive funds must buy. Mechanically, predictably, sometimes at any price. That can distort price discovery at the margin, especially in smaller names or during manic periods. Meanwhile, the largest ETF sponsors have accumulated massive voting blocks across corporate America and beyond. They promise stewardship. They publish principles. But stewardship is power. Over board seats, executive pay, climate policies, mergers, and takeovers. You may hold the shares, someone else often holds the microphone. The passive paradox is simple. As more money stops choosing, a shrinking minority chooses for everyone. If too many hands leave the wheel, the car still moves until a curve appears. 2 quiet engines help power the ETF machine. Securities lending and tax alchemy. Funds can lend out the stocks they hold to short sellers in exchange for a fee. Many share that revenue with shareholders. Some keep more than you might expect. The terms vary. The collateral quality matters. In benign periods, it's harmless income, a rebate from Wall Street's desire to borrow what you own. In stress, it's one more chain to tug. And the tax code, with its allowance for in-kind redemptions, lets funds offload low-cost basis shares to redeeming partners and reset the embedded gains. Some strategies use heartbeat-like creations and redemptions to cleanse those gains without a taxable distribution. Legal? Yes. Effective? Very. But deferral isn't avoidance. Eventually, taxes meet basis. When you hear tax efficient, ask, for whom and how? There's also the moment when the wrapper becomes the market. Flows chase performance, performance entices flows. Factor funds funnel capital into the same traits at the same time, lifting the same set of names together. Thematic funds pile into popular narratives. AI, obesity drugs, clean energy, defense, space, and sometimes push prices beyond what fundamentals can carry. Good returns attract dollars, which lift the holdings, which produce good returns, which attract dollars, until gravity returns. When the vehicle becomes the dominant way to own an asset class, the vehicle's mechanics start shaping the road. Futures-based products can pull demand forward and bleed it slowly through roll costs. Physically backed products can congest storage and delivery chains. The more popular the bridge, the more its architecture matters. History offers case files instead of hypotheticals. Bond ETFs have, in moments of stress, traded at persistent discounts to their published NAVs. That looks like failure. It's often truth. The underlying market was frozen, pricing by rumor and mark, while the ETF became the only place where real buying and selling happened. The price was ugly because the liquidity was expensive. If you had to sell, you could, and you paid for the privilege. Equity ETFs have dislocated at the open on wild days, when the underlying stocks haven't all set reliable prices. The ETF prints where willing counterparties meet. The lesson there isn't that the structure is broken. It's that your trading behavior matters. Use limit orders, especially near the open and the close. In a stampede, you don't bargain well with market orders. Commodity funds tied to futures have confounded investors who imagined a simple relationship between the thing goes up and my fund profits. When the curve's in contango, you can be right about direction and wrong about returns. The leak is invisible until you look at the plumbing. These aren't bug reports, they're features. The wrapper held, the currents showed. All of this invites a deeper, uncomfortable question. Who speaks for your shares? ETFs turned owners into passengers. You hold units in a fund. The sponsor often votes the underlying. There's a healthy debate about how that power should be used. Some argue for centralized stewardship, consistent policy, professional oversight, fewer knee-jerk votes. Others argue for pass-through voting. Let the end investors decide, even if many choose not to. A middle path offers choice menus. You pick a voting policy, and the sponsor follows it on your behalf. Each solution moves power between institutions and individuals, and each adds complexity somewhere. If ownership is voice, convenience can mute you. That may be fine until you care about what's being said. Meanwhile, the frontier keeps expanding. ETFs began with large cap stocks and broad indexes. Today, they reach into leveraged loans, slices of private credit, baskets of real assets, and exposures that once belonged strictly to institutions. A sleek wrapper now sits on spot crypto for those who can T or 1 T custody keys. For many, it's the only compliant path to exposure, but a regulated wrapper doesn't tame a volatile underlying. The asset still trades 24/7 in fragmented venues, driven by sentiment, liquidity, and reflexivity. The wrapper gives you convenience. It does not grant immunity. Thematic and narrative products proliferate. Some stories age into reality, others expire with the news cycle. Innovation is a gift. It's also an invitation to own first and understand later. So how do you navigate without drowning? You don't need to abandon ETFs. You need to respect them. Match the wrapper to the thing. For broad, liquid equities, ETFs are a triumph. Cheap, tax-efficient, transparent. For thin credit, small foreign markets, or esoteric commodities, expect bigger basis risk and wider spreads when the music stutters. Know your layers of liquidity. Screen volume is not underlying depth. In a sell-off, assume your exit price tracks the worst day in the underlying, not the best day in the wrapper. Read the documents, then the fine print behind the documents. Ask how the fund replicates exposure, full replication or sampling, physical or synthetic. What are the terms of securities lending? How concentrated is the authorized participant roster? What collateral stands behind a promise? If the language reads like alchemy, that IS, because parts of the system are just that. Engineered transformations designed to look simple on the surface. Trade with humility. Avoid market orders when volatility surges. Use limits. Be wary of the first and last minutes of the trading day, when noise is loudest and spreads are widest. If you're moving size, work with liquidity, not against it. Decide whether you want to vote. If corporate governance matters to you, choose sponsors that let you pass through a vote or pick a policy aligned with your values. If it doesn't, know who you're deputizing and what they stand for. For futures-based commodities or leveraged and inverse funds, add 2 rules. Watch the curve. Contango and backwardation shape your destiny more than the headline price. Mind the clock. Daily resets aren't designed for long horizons. If you want long-term exposure, use long-term tools. Underneath all of this is a larger lesson that reaches beyond tickers. Convenience reshapes the thing it touches. When the wrapper defines the flows redefine the prices. When passive becomes dominant, active becomes rare, and paradoxically, more valuable. When votes consolidate, governance centralizes. When taxes bend around innovation, incentives follow the bend. ETFs didn't make markets fragile. They made fragility visible. And sometimes they made fragility tradable. That's the bargain of modern finance. Ease in exchange for new kinds of risk. Efficiency in exchange for new kinds of power. Own the market was the promise. We built a machine that can do that. But machines obey physics. Push too much liquidity through a tight pipe and pressure builds. Route price discovery through fewer hands, and those hands matter more. Offer daily liquidity on top of assets that don't trade daily, and you've built a bridge that's only as strong as the next storm. The ETF revolution lowered costs, broadened access, and forced a level of transparency that exposed the gears. It also created new gears: authorized participants, arbitrage channels, collateral chains, voting blocks, each with failure modes that don't appear on a glossy fact sheet. So when you click buy, know the river you're entering. In calm water, the current is your friend. It carries you fast, and it feels like mastery. In rough water, the same current can pull you sideways, turn you around, and demand a price you didn't budget. That's not a reason to fear the river, it's a reason to learn it. Convenience with hidden currents. That's the truth of the wrapper. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.